I'm Charlotte McLeod with the Investing News Network, and here today with me is Will Rhind, CEO of GraniteShares. Thank you so much for being here online with me once again.
Thank you, Charlotte. Thank you for having me back. Good to be here.
Of course, and we're going to start off as we usually do with gold. When we last spoke in January, one of the main things we talked about was why the gold price was stuck under 1900. We're now about 3.5 months into the year, and it's more accurate to say gold is stuck under 1800. So, what's holding the metal down this year?
Well, I think the two main factors, Charlotte, are still in play, which is rising interest rates, although that has paused at least over the last sort of few days, a week or so, and a stronger dollar, which again has paused sort of in the last few days. So those have been the driving factors behind the gold price movement. I think what really is going on though is we're transitioning in terms of this gold market from a crisis hedge environment, which was very much what we saw last year, and obviously which propelled gold prices to an all-time high, to gold being not needed as a crisis hedge for the moment, and more we're transitioning into an inflation hedge environment. But obviously at the moment, we haven't reached that point where the market is sort of embracing the fact that inflation is a real thing. At the moment, it's still, we're seeing obviously rampant inflation in pockets of the market. But in terms of the broad CPI number, the number that most people associate with inflation, we haven't seen that at a level yet where gold prices have really responded.
Right. And inflation is definitely a topic that I've been hearing a lot about as we move into this year. What's your perspective on where that may go in 2021?
Well, I mean, we've had really quite dramatic increases in terms of commodity prices. A lot of commodity prices across the board. Everything obviously from oil, which hits people directly in terms of gasoline prices at the pump, to perhaps materials or commodities that people don't think about as much, like lumber prices, which recently reached an all-time high. And this is kind of on the back of a recovery situation, obviously, from the pandemic, where we've had depressed levels of supply into the market because of the pandemic, meeting a huge amount of demand as we come out. And so from that perspective, that's causing inflation, that is causing price rises. We saw major companies like Coca-Cola come out, announce there will be price rises in their product range. Also, consumer companies like Procter & Gamble, et cetera. So this is definitely a real thing. We're still very much in the early stages of it, I think, in terms of wholesale inflation across the board, but it's something that we're starting to see more and more creep into the mainstream media.
All right, we're going to come back to those rising commodities prices, but before we do that, what about gold for the rest of this year? Do you think we've seen the bottom in 2021 and moving forward will go higher or stay steady?
It's always difficult to say whether we've seen the bottom. I mean, I hope we have. We've certainly tested this level, kind of under 1700 a couple of times, seemed to meet some good resistance. And so from that perspective, I hope that has been the bottom, but you never know. Like I said, I think we are in a position or a moment of transition where we're transitioning away to a new phase of the gold market. And that is gold being seen as an inflation hedge. We've seen a lot of interest in broad commodities for that reason. And I think gold will see a lot of interest in that as well going forward.
Okay, well, always like to hear your thoughts about gold, but I know that among the precious metals, you're also bullish on platinum. So, to start off, for those who may not have been following the market, can you give me a sense of how that metal has been performing this year and if it's been as you expected?
Yeah, so platinum prices are up 10% year to date. So people have made money in platinum, but a little bit like some of the other metals, it has fallen a little bit from a high, a couple of months ago. But I think the demand for platinum is strong in the sense that, my view on why platinum is an attractive metal is not so much that it has immediate industrial demand coming from the automotive sector, which is still the largest part of demand for platinum. But I think that it's going to be a really important metal going forward as we transition to a sustainable, energy economy, a sustainable energy infrastructure, particularly in the production of hydrogen. So for green hydrogen and for hydrogen fuel cells, you need platinum. And so from that perspective, I think it could be, a metal like lithium. So, what
Mhm.
hydrogen I think can do for platinum, what batteries have done for lithium.
Yeah, and that was going to be exactly my question because you've mentioned before hydrogen fuel cell vehicles and platinum. Is that more of a future story than a right now story? Because to me, it seems like, the lithium ion battery vehicles, that's become quite mainstream, and the green car narrative still seems so centered around that.
Yeah, it's definitely become mainstream in terms of narrative, but it's not mainstream at all in terms of actual numbers of vehicles on the road. And so, electric vehicles, whether they're powered by batteries or whether they're powered by hydrogen, are still an incredibly small part of the global vehicle pool, if you will. And obviously, that market is growing. The battery powered electric vehicles are growing well, and it's very much the technology of the future. I just think that hydrogen is in that mix as well. It's not just a world,
Hmm.
the future state is not just a world where we only have batteries powering vehicles, but we'll also have hydrogen fuel cells powering vehicles. It may be in the heavier vehicle categories, but I think there's going to be good demand for it, and we're seeing everybody from governments such as the US government, other governments around the world, to obviously auto companies and other corporations start to invest serious money in the hydrogen economy. And so that is something for the future. It's not a right now story. There are
Hmm.
hydrogen vehicles on the road, of course, today. It is a technology that has existed for some time, but it's the green hydrogen element which is really important. And I think that's something that to keep an eye on, for the future.
Right. And then, of course, the other side of platinum in vehicles is, as you mentioned, platinum is used in auto catalysts in cars. So, is that a source of demand that we would see declining in the years to come? How does that play into this story for the metal?
Yeah, it's really interesting. So really that's been the main thing which has hurt platinum prices over the last few years.
Hmm.
So the distinction here is that platinum and its sister metal palladium are used as catalyst metals in catalytic converters. In other words, they clean the emission of cars. Now, the main distinction between the two is that palladium is typically used in gasoline engine vehicles, whereas platinum is used in diesel engine vehicles. So ever since the scandal, you may remember a few years ago with Volkswagen and the whole Dieselgate emission scandal, the demand for platinum and of course the platinum price has come down as the market viewed that diesel cars would lose market share to gasoline engine vehicles. And so that has been absolutely what has played out. There's less demand for diesel vehicles. Indeed, in some parts of Europe, diesel vehicles have almost been demonized from a sort of public perception basis because of that. However, that being said, I think that that sort of demand, if you will, has bottomed out, and that what is the kind of most immediate, I guess, bullish situation for platinum is that it can be used as a substitute for palladium. It can be used as a one-for-one substitute, and with palladium prices trading at almost twice the price of platinum, that has to be an attractive opportunity for automakers to substitute palladium for platinum. Now, obviously, there's longer term contracts and things that are already in place, but leaving aside that has to be an immediate term sort of opportunity for platinum, whereby automakers can start to substitute their catalytic converters, palladium catalysts for platinum. But yes, longer term, you're exactly right, that if the underlying demand for industrial, internal combustion engine vehicles declines, then demand for catalytic converters will decline, and that will affect palladium as well as platinum.
Okay, very, very interesting. We'll have to be watching that story moving forward. So we've talked about gold and we've talked about platinum. These are two metals that seem to have a bright future moving forward. And you've alluded earlier to the fact that many commodities right now actually may have a bright future looking into the forward. So we're seeing some momentum, and Some people believe that this is adding up to a new commodities supercycle. So, can you explain what that is and tell me if you think that's what we're seeing here?
So a super cycle, from a commodity perspective, is a period where we have sustained, increased demand for commodities and increased prices. And typically that's a multi-year thing, although there have been periods where super cycles have lasted for a decade or more. The last super cycle was in the early 2000s. And in the early 2000s, we had a situation where there were a lot of emerging countries around the world, significant countries, that were both urbanizing and industrializing on an unprecedented scale for the first time. Obviously, China being the largest and most significant of those countries. But this was also happening in Brazil, it was happening in India, it was happening in Russia and other places. And so these countries were consuming an enormous amount of commodities. And obviously this was a multi-year situation. And so it caused sustained rises in commodity prices across the board. And you can remember perhaps the price of oil going to an all-time high of around $150 a barrel, the price of copper going to a high, and all across the board, iron ore, et cetera. And obviously this was really sort of interrupted by the global financial crisis, which ultimately put the brakes on that commodity super cycle. But I think what the legacy in many ways from the financial crisis has been is underinvestment in the commodity space by commodity producers for a number of years now. And obviously some commodity markets went into a full-on bear market, after the super cycle ended, and industries consolidated, production was cut back. But I think the overarching theme here is there's been a woeful lack of investment in the space because of the reaction in terms of the underlying prices. Then obviously we had a pandemic situation which sort of further exacerbated that already situation where we had underinvestment in the space. And so that really impacted supply again on an unprecedented scale. A lot of mines, a lot of production facilities, et cetera, closed down. And whether you're in the energy space or whether you're in mining or any other commodity production, the pandemic was an incredible challenge. And so post-vaccine, as we're starting to recover, as we're starting to get out, we're seeing this environment where we have a huge ramp up in demand, but it's meeting all these supply constraints and backlogs, which have been accumulating now for many, many years, and obviously exacerbated last year. And that's resulting in big run-ups in commodity prices that people just didn't think were possible last year. And so I think that there's certainly the short-term effects of this are obvious, that this is a market that is recovering very quickly. You have some supply challenges across the market. That's been met with excess demand, and that's causing prices to go up. But I think the longer term effects here are a bit more. And that's why I do think that we are in the early stages of a new super cycle here. And the bigger picture is that we're transitioning our entire global energy infrastructure from an energy infrastructure that was purely reliant on hydrocarbons to one which will be hydrocarbon free. And we've got, again, governments right down to individuals really starting to think about that a lot more, and indeed, signing up in terms of governments, whether it's the Paris Accord or other, climate initiatives to cut back on emissions. And to do that, we're going to need a huge amount of investment in new technologies. And with that, a lot of commodities are going to be needed to get us to where we need to be. And one particular set of commodities that will most likely do very well are the metals, because we need rare earths, we need industrial metals such as copper and nickel, whether it's for production of green energy itself, or whether it's for battery storage, all these other things. And I think that's what's leading me to be very, very constructive on the outlook for commodities more broadly.
All right. And you mentioned this commodities super cycle being connected to a larger global transition. To me, that sounds like this means that this super cycle will be on the longer side compared to some of the ones you mentioned that have been shorter. Is that correct?
Yeah, I think so. I mean, I think the other big difference this time is just the amount of money that's been committed to this. So, people talk about the general monetary and fiscal environment and the easy money policies. But of course, that makes it easier, if that's the right word, to fund these kind of projects. And whether it's the Biden administration infrastructure plan here in the States, or whether it's European policies, they're all going to require a lot of money printing ultimately to pay for it. And so from that perspective, I think that it's bullish for the commodity markets more broadly. Now, it's not going to affect every commodity the same way, of course. Clearly, if we're transitioning away from oil, then the longer term picture for oil is not going to be positive. But I think for any commodities that are needed for a infrastructure build out and a transition to a new economy, that is, of course, a longer term positive for those.
Right. And I think you're kind of getting toward this, but for an investor, how do you play this kind of situation? It definitely sounds great to be in an environment where commodities are on the rise, but I'm guessing it can't be quite that simple.
Well, it depends on, again, whether you're talking about on a short-term basis or a longer-term
Hmm.
perspective. Because I can tell you that at GraniteShares, I mean, we've had, I'd say, the most interest in broad commodities, a simple broad commodity ETF. Our ETF is COMB. The most interest in that for a number of years, and that's just investors looking for a hedge against inflation. And obviously, the reason is that probably the two most well-known applications for commodities in a portfolio or in a portfolio context are, number one, it provides diversification because it's a different return stream than what you get from equities and bonds. And number two, it's a hedge against inflation. And so that's what people are really reaching for at the moment. It's less about a super cycle. It's less about a long-term story. It's more about a hedge and getting something in the portfolio that reacts differently to what you already have. So that's certainly something that's playing out and something that's very important to people right now. But longer term, I think it's people really have to take a view on which way this is all going. And obviously, within that, there'll be winners and losers, and whatever underlying commodities people think will profit the most, whether that's platinum, whether that's copper, whether that's there could be all sorts of permutations of it. Maybe even commodities that we don't really think of that much today that might become very important to us in a few years' time.
Okay, certainly very interesting. And on the note of products from Granite Shares, I want to end with something a little bit different. I wanted to ask you about Granite Shares HIPS US High Income ETF. I wondered if you could tell us a little bit about that and what does it offer investors exposure to?
Yeah, so this is really about trying to solve the income crisis that we have here in the United States and really a lot of the Western world, where we have interest rates at zero, we have very loose monetary policy, and all of that all of that being said, people need to pay bills. We need income. We can't survive without it, and so how do we create meaningful amounts of income, especially in an inflationary environment? And so the idea behind HIPS, and HIPS, the acronym stands for High Income Pass-Through Securities, is it's a fund that at the moment yields 8.05%. That's net of all fees. And it does that by investing in a class of security that people probably don't know that well, or certainly less well than traditional equities and bonds, and that's pass-through securities. And pass-through securities are things like REITs, things like MLPs or master limited partnerships, business development companies or BDCs, and closed-end funds. And these all have one thing in common, and that's they don't pay any corporate income tax. And so automatically, sort of off the bat, you're starting with a higher level of income because you're not subject to corporation tax. And so these particular instruments or these underlying securities required by law to pass through almost all of their income directly to shareholders. And so putting those together in a portfolio, you create a diversified portfolio that gives a really high level of income to investors, one of the highest yielding ETFs actually in the market. And those are distributed monthly. So we pay a consistent monthly distribution. And we've done that ever since the inception of the fund. So it's becoming a very attractive alternative for people who are desperately, seeking income, but the traditional strategies that they had in place, pre-COVID, no longer work, in a zero interest rate environment. And so people are having to replace that income. If your income portfolio was generating 4%, or 5% pre-COVID, and now it's 2%, then you're having to replace that lost income. And people are finding there are not many ways you can do that. And so HIPS is one solution to that we're finding to be very popular with investors.
Very interesting. And I do feel like we've gone a little bit full circle here talking about, gold as a hedge against inflation. And this is another way to deal with this environment that we find ourselves in.
Yeah, absolutely. It's just a different sort of angle, or a different side of it, where one of the direct consequences of not just lower interest rates, but of this environment where we're printing money and we're devaluing the value of the dollar and other currencies around the world, is what that does is we're taking money away from savers effectively and giving it to debtors. And that's what the effects of the money printing sort of policies are doing. And so for savers, you have to counteract that in some way. And one of the ways you can do that effectively, you can still generate higher levels of income, but you have to step outside the boundaries of traditional strategies, which arguably no longer work as well as they did before.
Very informative as usual. As we are wrapping up, are there any final thoughts that you would leave investors with heading into the rest of Q2?
Well, I think that I guess final thoughts would be the market obviously continues to recover. And I think we're seeing positive data, fundamental data, economic data coming out, which supports that case. So I think from that perspective, the economy is really is gaining strength here, and so I don't think that will change. I think it's going to be a positive year, for the market, for the economy more broadly. And I think certainly kind of recovery plays, or anything that manages to try and put an inflation hedge in there, is probably something investors should look at.
All right. Well, thank you so much for coming back to talk. Always great to hear your thoughts on the market.
Thank you. Great to have you. Thank you very much for having me.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Will Rhind with GraniteShares.